Welcome to The Explainer. Today, we're cracking open one of the most powerful investing systems ever developed, based on the classic book, How to Make Money in Stocks. We're going to find a proven way to win in the market.
All right, let's jump right in with a little pop quiz. You've got 3 stocks here. Take a look. Stock A, it's riding high, near its peak. Then you have B and C. They've taken a pretty big tumble, so they look a lot cheaper. Just go with your gut on this one. Which one feels like the best buy?
So if you picked B or C, you're in good company. I mean, that's what most people do, right? It feels safer to buy something on sale. But, and this is a big but, history tells us that stock A was the real superstar. And this gets to the heart of what we call the market's great paradox. What seems way too high and risky just keeps climbing. And what looks like a bargain, well, it usually just keeps getting cheaper.
Now, this isn't just some random opinion or a hot take. This whole idea comes from a truly massive study. We're talking 125 years of market data. The goal wasn't to predict the future or find some magic formula. It was way more powerful to look back at all the biggest stock market winners and figure out what they all had in common before they made those incredible runs.
And you know what they found? It pretty much turns conventional wisdom completely on its head. We're always told, buy cheap stocks, look for a low PE ratio. But the data from these huge winners, it showed the exact opposite. The real champions were the stocks breaking out to new highs, the undeniable leaders in their fields. They weren't bargains, they were the best of the best, and they were priced like it.
Okay, so what does this all mean for us? It means these super stocks, these market legends, aren't random. They actually share a kind of blueprint, a common DNA. And the best part is, we can learn to spot it.
The first part of this DNA is all about the fundamentals, the engine of the company. We're not talking about slow and steady here. We're looking for explosive growth. Think current earnings jumping up by at least 25 or 30%. And that growth has to come from somewhere, right? It's usually a catalyst, a game-changing new product, a brilliant new CEO, something that's shaking things up. And you want the captain of the team, the clear leader in a hot industry, not some second-string player.
But here's the thing. Amazing numbers are only half the equation. The fundamentals tell you what company to buy, but the chart, its price and volume action, that's the visual signature that tells you when to buy. It's like the market's tell in a poker game. The biggest winners almost always give you a heads up before they make their big move.
And the most classic, most reliable of these visual signatures is something called the cup with handle pattern. Seriously, think of it like a slingshot being pulled back. First, the stock has already had a nice run-up. Then comes the cup. That's when it pulls back and builds a solid base, shaking out all the nervous owners. Then you get the handle, this little final dip where the pressure just builds and builds. That moment it breaks out above the handle, that's your launch point. That's the signal that it's ready to fly.
Okay, so you've found a great company, you've timed your entry perfectly. You're all set, right? Wrong. Buying right is only half the battle. You can have the best stock-picking system in the world, but if you don't know how to protect your capital, you will lose. And that brings us to the single most important rule in this entire system, and it's all about defense.
The legendary trader Bernard Baruch said it best. He basically said you don't have to be a genius who's right all the time. In fact, you're going to be wrong a lot. The key to winning big is making sure that when you are wrong, the damage is tiny.
And that brings us to the single most important number in this entire strategy.
7 to 8%. That's it. This is the one non-negotiable, absolute, ironclad rule of the whole system. You sell any stock every time if it falls 7 to 8% from what you paid. No questions asked, no hoping it'll come back, you just cut the loss. It's a mechanical rule that takes your ego right out of the equation.
The best way to think about this is like insurance, right? You don't buy fire insurance for your house because you expect it to burn down. Of course not. You buy it to protect yourself from that 1 in a million chance of a catastrophic event that you can't recover from. That's exactly what this rule is. It's a cheap insurance premium you pay to protect your portfolio from a fire that could wipe you out.
And if you don't believe me, just look at the math, because the math does not lie. If you take a small 8% loss, you only need about a 9% gain to get back to even. No big deal. But if you let that loss spiral down to 25%, now you need a 33% gain just to break even. And if you let it hit 50%, you need to literally double your money on what's left just to get back to where you started. That's not investing. That's climbing Mount Everest with no gear.
So, let's wrap this all up. What's the takeaway here? First, you got to defy conventional wisdom. Start buying strength, not weakness. Second,
You learn to spot the winners by looking for that combo of explosive growth and that classic cup with handle chart pattern. And most important of all, you play ferocious defense. That 7 to 8% loss-cutting rule isn't just a suggestion. It is your key to survival and ultimately your success.
So that leaves us with one final and maybe uncomfortable question. If we know that this one simple, disciplined sell roll is maybe the biggest thing separating amateur results from professional results, what's really stopping you from using it? Is it hope? Is it ego? Is it the fear of being wrong? It's really something to think about.